Most people in this country believe that transferring money to a family member is an entirely personal matter. A birthday check for a nephew, helping a niece cover tuition, contributing toward a child's first home purchase. Intimate, straightforward, no one else's concern. And for a considerable stretch of time, that was genuinely accurate. The IRS was physically incapable of tracking a financial exchange between two relatives unless that person was already being audited and a human examiner specifically dug through the records. That era has now come to a complete and permanent end. As of 2026, the IRS is operating 129 active artificial intelligence programs, up from just 54 programs a mere 2 years ago. These programs pull financial data from every bank in existence, every digital payment platform, every brokerage account, every mortgage company, and every state tax authority across the country. They do not go offline. They do not observe holidays or weekends. And their singular function is to detect transfers that the IRS believes should be classified as taxable gifts, or should at minimum be formally explained. If you have been moving money to relatives under the assumption that nobody was paying attention, I am sorry to be the one to inform you. Someone most definitely is paying attention now. The first concept you need to grasp is that the IRS is not relying on a single AI platform. It is running 4 distinct systems, each architected to target a different category of taxpayer. The oldest and most well-known among them is called the Discriminant Function System, commonly referred to as DIF. This system has existed in some form since the 1960s, but the version operating today bears almost no resemblance to its original iteration. It scans every individual tax return filed in the United States and cross-references the figures on your return against statistical benchmarks for people who demographically resemble you: your age, your income level, your zip code, your occupation. If your deductions shift abruptly from one year to the next, if your bank deposit totals do not align with your declared income, if you are logging suspiciously round figures rather than precise dollar amounts, DIF does not send your file to a human agent. It routes it directly to another algorithm. The second system is called the Individual Taxpayer Model. This one is more recent and considerably more formidable. Rather than examining a single year of tax filings, it evaluates your entire submission history. 5 years back, 10 years back, 20 years back if you have been filing that long. And it does not simply raise a flag over inconsistencies. It identifies the 3 specific items on your return that are most statistically likely to produce a tax adjustment if an examiner actually opens the case. Put another way, if you are ever audited, the IRS has already identified its targets before an agent has even pulled up your name in the system. The third system is called the Line Anomaly Recommender. This is the newest of the 4, having replaced the previous methodology the IRS used to select corporate returns for examination. It currently scans filings from high net worth individuals who are reporting business income, partnership income, and real estate holdings. Rather than evaluating a single line item on your return, it analyzes the mathematical relationships between every line and measures whether they are consistent with one another. If your depreciation figures do not reconcile with the asset pool you have declared, or if partnership distributions do not align with your capital account balance, the system will flag the discrepancy. The fourth system is the most aggressive of all. It is called the Large Partnership Compliance Model. Prior to 2021, the IRS identified only a handful of large partnership returns annually for audit review. After this system was activated, that figure surged to 82 flagged returns in a single year, an increase of somewhere between 10 and 100 times the previous audit intensity. If you are involved in any kind of family-limited partnership, family trust structure, or pass-through entity that holds family-owned assets, this is the system that has its eye on you. All 4 of these systems draw from a shared data repository the IRS calls the Compliance Data Warehouse. It contains a record of every dollar you have ever deposited into a financial account, every tax form your employer has ever submitted on your behalf, every 1099 the IRS has ever received bearing your name, every payment app transaction that has been reported to them, and every suspicious activity report any bank has ever filed with your name attached to it. None of this data collection requires a court warrant. None of it requires that you be notified in advance. The IRS is under no legal obligation to inform you that this data exists in their system. It simply does. Let me walk you through exactly how this apparatus catches ordinary families in the real world. Picture this scenario. You have been transferring money to your adult son, $10,000 at one point, $15,000 at another, spread across a 3-year window. Some of it was cash handed over in person, some was sent through Zelle, a couple of transfers went through Venmo for the larger round number amounts. The whole thing felt casual and personal. 6 months later, your son walks into an auto dealership and places a $70,000 down payment on a new truck. The dealership is required to file IRS Form 8300, a federal document specifically created to capture large cash transactions. The title company transmits the loan information to the credit bureaus, which the IRS also monitors. Your son then files his annual tax return, declaring an income of $42,000. The IRS artificial intelligence system now identifies a discrepancy, $42,000 in reported earnings against a $70,000 down payment, with no inheritance recorded anywhere in the system. That is a lifestyle-to-income mismatch, and it triggers an automatic flag. From that flag, the algorithm traces backward through his banking records to locate the origin of the funds. That is precisely the moment your Venmo payments to him start appearing on the system's radar. The algorithm has no capacity to understand that you love your son. It only needs to detect the pattern. Once detected, the case enters a queue for eventual human review, and by the time an agent examines it, your entire 3-year gifting history has already been assembled into a clean, chronological timeline. Now, let us get into the specifics of how gift taxation actually works, because this is where most families unknowingly create serious problems for themselves. The annual gift tax exclusion for 2026 stands at $19,000 per recipient. This means you can transfer up to $19,000 to any single individual, a child, a grandchild, a niece, even a close friend, within a single calendar year without owing any tax whatsoever. Married couples can double this figure by electing what is called gift splitting on IRS Form 709, bringing the combined threshold to $38,000 per recipient per year. Transfer $38,000 to your adult son, and the transaction is clean. No tax owed, no form required, nothing to report. Do it again in January of the following year. Still completely clean. But the moment your transfer exceeds that annual threshold by even a single dollar, the entire dynamic shifts. You are now legally required to file a gift tax return, Form 709. And here is where the vast majority of Americans encounter a jarring surprise they never anticipated. Form 709 is not merely a disclosure document. It is the instrument that initiates a 3-year window during which the IRS retains the legal authority to audit that gift. If you file it correctly and completely, the agency has 3 years to challenge the transaction. After that window closes, they are legally barred from pursuing it. That is the encouraging news. The discouraging news is this. If your Form 709 contains what the IRS classifies as inadequate disclosure, that 3-year window never opens. Not after 3 years, not after a decade, not ever. The IRS retains the right to audit that gift 20 years from now, 40 years from now, after you are gone, after the recipient is gone, and still demand full payment of any tax owed, plus penalties, plus compounded interest accumulated over all of those years. And the definition of what constitutes inadequate disclosure is shockingly expansive. Writing gift to nephew on the form rather than cash gift of $1,800 to John Doe, Social Security number ending in 4877, that is inadequate. Omitting the fair market value of the asset on the precise date the gift was made, that is inadequate. failing to describe the transferred asset in enough detail for a professional appraiser to evaluate it independently, that is inadequate. The overwhelming majority of people who complete their own Form 709 submissions do so inadequately, and the IRS has absolutely no incentive to correct them. In fact, from an enforcement standpoint, the agency benefits from your error, because an inadequately disclosed gift has no statute of limitations, ever. This is not a remote or theoretical risk. It is the single most prevalent gift tax trap in the entire federal tax code, and it applies even to small transfers because a minor gift that was improperly filed carries no statute of limitations regardless of the dollar amount involved. The lifetime estate and gift exemption for 2026 is $15 million per individual, a figure established under the One Big Beautiful Bill Act, enacted at the end of 2025. What this means in practical terms is that as long as your cumulative lifetime gifts remain beneath that $15 million ceiling, you will not actually owe any federal gift tax when you submit the 709. But you are still legally obligated to file it, and to file it correctly, or the IRS retains permanent jurisdiction over that transaction. Most people reason that if the resulting tax liability is zero, the quality of the disclosure is irrelevant. That assumption has cost American families tens of millions of dollars in back taxes and penalties over the past decade alone. Now let us address what is genuinely new in 2026, specifically how the IRS monitors your digital payment activity. This is the first year in which the 1099-K reporting threshold has been definitively settled following years of legislative back and forth. The current rule is as follows. Payment platforms are required to issue both you and the IRS a 1099-K if you receive more than $20,000 in a calendar year and conduct more than 200 separate transactions on that platform, classified as payments for goods or services. Both conditions must be satisfied simultaneously. One alone is insufficient. This is the rule established under the One Big Beautiful Bill Act, and it is widely expected to remain stable going forward. Venmo, PayPal, and Cash App all operate within this framework. Personal transfers between friends or family members that are designated as not for goods or services are not subject to this reporting requirement. Transfers between legally married spouses are similarly exempt. Zelle does not issue these reports at all because Zelle does not technically hold funds. It simply facilitates their movement between bank accounts. As a result, many people have concluded that Zelle transactions are invisible to the IRS. That conclusion is entirely wrong. Your bank observes every single Zelle transfer flowing through your account, and your bank is legally required to report suspicious transaction patterns to the Treasury Department's Financial Crimes Enforcement Network, known commonly as FinCEN. That network shares everything it collects with the IRS. So if you Zelle your adult daughter $15,000 every month on a predictable schedule to cover her rent, it is conceivable that no one takes notice. But if you send her $30,000 in a single day, followed by $10,000 the following week, followed by $5,000 3 days after that, your bank will almost certainly file a suspicious activity report, and you will have no knowledge of it whatsoever. This is the specific obligation embedded in Title 31 of the United States Code, Section 5318. Financial institutions are legally prohibited from disclosing to you that such a report has been filed. You will only learn of its existence if and when the IRS arrives with questions. There is one additional bank reporting threshold every American family needs to understand. It is called a currency transaction report, and it is automatically triggered whenever you deposit or withdraw more than $10,000 in physical cash. The bank exercises no discretion in this matter. It does not matter that the funds belong entirely to you. It does not matter that your purpose is entirely lawful. The bank files a FinCEN Form 104 every single time the threshold is crossed. The IRS has direct access to this database through a mechanism called the Bank Secrecy Act search tool, and they can query it without obtaining a court order, without alerting you, and without even informing their own senior leadership. Before I go further, I need to pause and address something that the vast majority of Americans have never encountered in any financial conversation. Yet it is the single most consequential family money mistake I see repeated over and over. It involves joint bank accounts. When children reach adulthood, many parents instinctively decide to add them as joint account holders on the family checking account. The logic is practical. If the parent becomes ill or incapacitated, the child can step in and manage the bills. It feels like sensible planning. It feels like an expression of trust. Under American tax law, it is frequently one of the most financially destructive decisions a family can make. The instant you add an adult child's name to an account you own, the IRS has grounds to assert that a portion of those funds was gifted to them on the day their name was added to the title. The agency does not always pursue this argument, but if you ever need to demonstrate during an audit, a probate proceeding, a family dispute, or a divorce proceeding that no gift occurred, the burden of proof rests entirely with you, and the paper trail is permanent and immutable. Every deposit flowing through that account becomes partially attributed to the co-owner. Every withdrawal the joint account holder makes is subject to scrutiny as evidence of beneficial access. If your child pulls $10,000 from the joint account to repair their vehicle, the IRS is entitled to characterize that either as a gift from you or as an advance distribution from an anticipated inheritance. Either characterization creates significant tax complexity. The second major trap embedded in American family wealth transfers involves the distinction between property received as a gift during someone's lifetime versus property received as an inheritance after someone's death. It is a distinction most families stumble into without any awareness of what they have triggered. Here is how the rule operates. If your mother transfers her home to you as a gift while she is still living, you inherit her original cost basis in the property. If she purchased that home in 1985 for $60,000, your basis is $60,000. When you eventually sell that property for $600,000, you owe capital gains tax on the full difference, $540,000 of recognized gain. At the 20% long-term capital gains rate, compounded by applicable state taxes and the 3.8% net investment income tax, you are looking at a tax bill potentially exceeding $130,000. But if instead she bequeaths that same home to you through her will upon her death, you receive what the tax code calls a stepped-up basis. Your cost basis resets to the fair market value of the property on the date of her passing. In this example, $600,000. If you sell it the following day for $600,000, your recognized capital gain is precisely zero. Your tax liability is precisely zero. Families throughout this country are transferring real estate to their children during their lifetimes under the sincere belief that they are being generous and reducing future estate tax exposure. And in doing so, they are unknowingly delivering their children a six-figure capital gains obligation that the IRS will patiently collect the moment the property is eventually sold. Every family contemplating a real estate transfer must internalize this distinction. A lifetime gift carries the original basis and creates a future tax. An inherited property receives a stepped-up basis and typically generates no tax at all. If you are financially able to hold the asset until death, the numbers almost always favor doing exactly that. And in April of 2025, the surveillance landscape grew even more intense in certain regions of the country. FinCEN issued what is called a geographic targeting order, which reduced the currency transaction reporting threshold for money services businesses operating in southwestern border zip codes from $10,000 down to just $200. That order ran through September of 2025. Comparable orders have been issued and subsequently extended in additional regions since that time. If you reside near a designated target zone and you walk into a Western Union location carrying $300 in cash, you have now entered the FinCEN database on a permanent basis. So what does all of this mean for ordinary American families who simply want to help one another financially? The most foundational thing to understand is that operating without awareness of the rules is no longer a viable approach. The IRS employed approximately 102,000 people at the start of 2025. By December of that same year, that headcount had dropped to 74,000, a 27% reduction in human personnel in under 12 months. And rather than scaling back its enforcement capacity in response, the agency moved in precisely the opposite direction. It dramatically expanded its investment in artificial intelligence. The IRS now audits with extraordinary surgical precision. Fewer cases are opened, but every case that does get opened was selected by an algorithm that has already identified what it intends to find before a human examiner ever touches the file. The audit rate on gift tax returns has historically hovered around 1%. It remains approximately there today. That sounds relatively benign until you recognize that the audit rate on estates valued above $10 million is 22%, 1 in 5. And the audit rate on any filing that the AI system has flagged as inadequately disclosed is substantially higher than the published baseline rate, because those filings carry no statute of limitations, and the IRS can hold them in reserve for decades, waiting for the moment when enforcement priorities, budget availability, or a fresh set of eyes on the database make pursuing them worthwhile. Now for the constructive side of this conversation. There are 5 specific strategies that families across America employ every single day, entirely within the law, that effectively navigate around all of this surveillance infrastructure. The first is gift splitting. If you are married, both you and your spouse may each contribute the full annual exclusion amount to the same recipient within the same calendar year. This means a married couple can jointly transfer up to $38,000 per recipient per year with zero tax liability and no Form 709 required. A couple with 4 adult children can legally move $152,000 per year into the next generation every single year, without filing a single piece of paperwork with the IRS. The second strategy is called the direct payment exception, and it is among the least well-known and most powerful provisions anywhere in the federal tax code. If you pay tuition directly to an accredited educational institution, or pay medical expenses directly to a hospital or healthcare provider on behalf of another person, the IRS does not treat those payments as gifts at all. Not partially, completely. You can pay $100,000 toward your grandchild's university tuition this year and not consume a single dollar of your annual exclusion or lifetime exemption. The payment is entirely invisible within the gift tax framework. The sole requirement is that the funds flow directly to the institution rather than passing through the family member's hands first. If the money touches your grandchild's bank account before reaching the university, it qualifies as a taxable gift. If you write the check payable directly to the university, it does not. The third strategy is the 5-year election available for 529 college savings plans. A 529 account offers substantial tax advantages for educational savings, and a special provision in the tax code permits you to treat a single large lump sum contribution as though it were spread across 5 consecutive years. This means that in 2026, you can contribute $95,000 to a single beneficiary's 529 plan in one transaction, file a Form 709 declaring the 5-year election, and the entire contribution is treated as 5 annual gifts of $19,000 each, fully within the annual exclusion, completely legal, with the invested funds growing tax-free, distributing tax-free when used for qualifying educational costs, and never appearing as a reportable gift in any subsequent year. The fourth strategy centers on what is called a crummy trust, a name derived from a 1968 court case, not a commentary on the quality of the structure. A crummy trust allows you to deposit funds into an irrevocable trust established for a named beneficiary. provided that the beneficiary is granted a brief annual window during which they have the right to withdraw the contributed amount. The contribution qualifies as a present interest gift and draws upon your annual exclusion. This is the mechanism through which wealthy families transfer tens of millions of dollars across generations without ever generating a taxable gift. You contribute $19,000 per beneficiary per year. The beneficiary receives written notice that they may withdraw the funds within a 30-day window. They elect not to. The funds remain within the trust. You repeat this every year for 3 decades. You have now legally transferred $570,000 per beneficiary with zero gift tax exposure. Scale this across multiple beneficiaries spanning multiple generations, and the cumulative wealth transfer potential becomes extraordinary. The fifth strategy involves spousal transfers. Federal tax law treats a legally married husband and wife as a single economic unit for purposes of gift taxation. You may transfer to your spouse any amount of money, any asset, any piece of property, any portfolio of securities, and it is not classified as a gift. It generates no reporting obligation, and it consumes none of your lifetime exemption. Spouses are effectively transparent to the gift tax system entirely. The practical significance of this is that many families use spousal transfers as a strategic rebalancing mechanism. If one partner holds an asset they wish their children to eventually inherit, they can transfer that asset to the other spouse first and then have that spouse execute the gifting. This activates an entirely separate annual exclusion and a fully separate lifetime exemption for the gifting spouse, effectively doubling the family's total tax-free transfer capacity in any given year. So here is how you protect yourself and your family without becoming a data point the algorithm finds interesting. The first shift is conceptual. Stop framing your thinking around what you are permitted to give, and start thinking in terms of what you can document with complete clarity. Every transfer should carry an unambiguous notation. Every transaction should have an identifiable rationale. Every gift that exceeds the annual exclusion must be reported on a properly completed Form 709 with full and adequate disclosure. Second, actively use the provisions the tax code has already placed in front of you. The direct payment exception, the 529 5-year election, the crummy trust structure, the gift-splitting election. Third, recognize that the IRS artificial intelligence infrastructure will continue to grow more capable, not less. The agency is contracting in terms of human workforce, but expanding in terms of computational power. Fewer returns will be examined next year than this year, but the ones that are selected for examination will be chosen by systems that have already mapped out the full financial picture before anyone picks up a phone. You do not want to be in the data set the algorithm surfaces when it runs its next cycle. Let me close with one final real-world scenario that is currently playing out in tax proceedings across this country. A grandmother in Pennsylvania transferred $90,000 to her grandson over 4 years to support him through medical school. She had no knowledge of the annual gift tax exclusion. She submitted no Form 709 for any of the transfers. She wrote every check directly to her grandson because she loved him unconditionally and wanted him to become a physician. 3 years after the final check cleared, her accountant submitted her annual income tax return, and the IRS artificial intelligence system flagged an anomaly, not within her return itself, but within her banking records. The algorithm detected that her checking account was generating large outgoing transfers inconsistent with her normal transaction patterns, while her grandson's account was receiving deposits inconsistent with his declared earnings. The case took 2 years to work its way through the IRS internal review process. By the time it reached resolution, the grandmother had passed away. Her son, serving as executor of her estate, was presented with a bill for $72,000 in back gift tax liability, accumulated penalties, and compounded interest. Had those same gifts been properly reported on Form 709 filings with complete and adequate disclosure, the total tax owed would have been exactly zero. because the cumulative amount fit comfortably within her lifetime exemption. She simply never filed the required paperwork. That is how family wealth is lost, not through complicated tax avoidance schemes gone wrong, but through complete unawareness of what the algorithm is trained to detect.